Have you ever wondered why global investors are suddenly panicking about bonds? Why are long-term United States bonds breaching a 5% yield ceiling for the first time in decades? And why does this matter to you, whether you are in India, the United States, or anywhere in the world? Let us break it down. In May 2025, global bond markets saw a major shakeup. United States 30-year Treasury bonds crossed a 5% yield for the second time this week, and 10-year bonds also crossed their psychological barrier of 4.5%. What does this mean? When bond yields go up, bond prices go down. So a rise in yields is actually a sign that investors are selling off bonds quickly. Now let us understand why this is happening. There are two big reasons. First, structural changes in who is buying bonds. Earlier, central banks were the main buyers. They do not care much about short-term price changes. But now hedge funds and mutual funds, who are very sensitive to bond prices, have taken over. So any bad news causes a sharp sell-off. Second, macroeconomic concerns, especially in the United States. Donald Trump's tax and spending plan is expected to add over 3.3 trillion United States dollars in new debt by 2034. And investors are asking, who is going to pay this back? Think of it like this. If a family keeps borrowing more and more but never cuts spending, lenders start demanding higher interest to lend them money. That is exactly what is happening in the United States. In fact, America's total debt is now 122% of its gross domestic product. If you want a detailed explanation on how government debt works, I covered that in my earlier video. You can watch it using the link in the description. Now here is another interesting point. Normally, when the economy slows down, bond yields fall. But this time, tariffs are making things worse. Tariffs reduce trade and slow growth. That means lower tax collections, and that creates even more pressure on government debt. So yields are rising instead of falling. It is like running out of income and borrowing more on your credit card. Your interest rate will shoot up. This is pushing up something called the term premium, which is basically the extra return investors demand for locking in their money for 10 years or more. It is now near a record high at 0.75%. And it is not just the United States. In Japan, the 30-year bond yield hit a record 3.18%, the highest since 2006. The Bank of Japan has scaled back its bond purchases, and now there is concern about who will buy their bonds. In Europe, bond yields are also rising, but not as sharply. That is because countries like Germany still have better control over spending. Germany's debt is only 63% of gross domestic product. So what is the takeaway? This is not just market noise. This is a structural shift in global finance. If you think bonds are boring, think again. They are at the center of everything from interest rates to inflation to your future investment returns. And this bond market volatility is a warning sign about rising debt, falling trust in governments, and a shift in global investor behavior. So next time you hear someone say bond yields rose today, you will know it is not just a number. It is a signal, a big one. If you found this video helpful, do not forget to like, share, and subscribe. And if you want to understand the concept of government debt in more detail, check out my earlier video linked in the description. It will give you the full background. See you in the next one.